Okay, good morning. So today, I want us to analyze the fresh market. Today's date, 14th February 2025. So I want us to look at the fresh market entirely, and I was actually going through volatility 100, and I saw a few things that actually interest me. So I think we should analyze this. Now, don't forget, we are still on our first topic, which is structure. Like I said, for you to be able to trade any market, the first thing you must be able to do is that you must be able to understand the structure. You must be able to determine the structure of that market. Now, when you determine the structure of that market, you are now able to form what is called market bias. Bias, to be biased means to form an opinion about something. So for example, I can say that my opinion about Nigerian government is that the Nigerian government is corrupt. So now that is my bias. I might be correct, I might be wrong. And that is how market is. That's how trading is. Your opinion, your bias, you might be wrong, you might be right. So that's why you want to make sure that you are right with your bias. So now the bias in a trading market is to say that this market is a buy market or is a sell market. And like I told us, a buying market is a market that is trending up, is bullish. When the market is trending up, we say it's bullish. When a market is trending down, you will say it's bearish. That is a selling market. So now, for us to be able to identify the structure of a market, we have to go to big time frame to determine that. Like now, if you look at this now, this is a 30-minute time frame. Let me start using my arrow. Look up here. This is volatility 100 index. M30 means 30 minutes. So each of the candle on this chart now, it took 30 minutes for each of these candle to form. So now we want to go to bigger time frame because it is the bigger time frame that can tell you the original or the primary direction of this market. So let's go to daily. That is D1. I will click D1 on this menu. D1. So now we are on daily. So each of these candle here now, it took 24 hours for each of them to form. So you can imagine. So each of these candle now represents what happened in each day. So let me increase it. All right. So each of these candle took 24 hours for each of them to form. Now, what we want to determine now is the structure of this market. What is a structure? Structure means that the way the market is moving, you want to be able to say this market is moving this way or this market is moving that way. So how do we determine that? I'm going to squeeze my chart. So now I'll squeeze my chart. And at the same time, for me to be able to have a better understanding of this market, I may need to slant my phone. If you are using a laptop or a system, it will be clearer, but I'm going to slant my phone now because I'm using a mobile phone. So for you also to be able to see more events on the chart. Okay, so I've slant my phone now so you can see now. So now I will now say, let me now show us now what we mean by structure. So structure means if you look at this chart, you can see that different candles come up, but in the way they come out, the chart, the movement of the candles, it forms certain pattern. So let me first of all analyze the pattern now. Let me analyze from this place. So you see that this market at some point it traded down from here, it traded down here, then it went up to this place. So now when it got to this place, it came down. But when it was coming down, don't forget, it did not touch this place. It didn't get to this down part anymore. It stopped here, then it went up. Now when it's going up here, see, it went be above this place. You see, it went up. So that means it break this limit upward. Then it came down. When it was coming down, it didn't come down to this place again. Don't forget, this one did not get to this place when it was going down. This one now, it didn't get to this place. So it traded down from here, but it didn't get here. So that means it now went up. When it was going up, it broke this one, and went up here. So this show now that this market is trading up. So for example, let's assume you bought this market at this place. Let's assume you bought at this place and it went up into profit. By the time it came back here, it will take you into a loss. By the time it went up, it take you into higher profit. So now what that means is that this market can only be bought. So if you buy this market as it's trending up, trending higher, your money will be growing. But if you sell this market, you will be in trouble. So let's continue. So this market went up here, then it came down here. You see? Then it went up here to break this place and went higher. Then it came down here. Then it went up here. But if you look at from this place to this place, you notice something. You notice that the way it's going high has reduced. The way it's going high has reduced. It came down here, then it went up. It just went up a little above this, then it stopped. So it was showing what we can call market fatigue. The market has become weak. The going up has become tired. So see what now happened from here. From here now, it now came down and broke this higher low. This the last higher low, it broke it down. So now immediately break this place, we call it change of character. It means that this market now have stopped buying, this market want to start selling. So one of the things you can use to identify a trend market is to use a trend line. Let me bring out a trend line. This is a trend line. Look at this. You can connect from here. You can see this market. You see, it was touching consistently, bouncing up on that line. So at some point, see the market, this candle now broke this line. You break it down to the down part. And now after I break it down, you see that the market is going up again. This market now is going back to touch this line. Once you touch this line, this market will start selling. So now this market now already is already in a we're already in a selling regime. Downward trend want to start. So the best way to trade this market now is for a trader to wait for this market to go up to this side. When it comes to this side, then you go to smaller time frame. Let's go to smaller. Then you come to smaller time frame, maybe like 30 minutes, and wait for the market in smaller time frame to give us a downward pattern or a signal that signifies that the market want to start going down. Then we will take a short, that is we will sell. So that is how to take a market. You start from a big time frame to understand the market bias. So this market now, if anybody starts buying now, at this point, you are looking for trouble because the market is already tired of buying. The market has fallen. You can see from here, from here, look at it. This candle here, you see the candle is very bold and strong. It broke the line and went down, and now it's going back to retest the price. It want to renegotiate if it can go up, but automatically it will never be able to go up again. So the sellers are going to take over this market, and this market are going to start selling very so why I'm analyzing this market is not because we want to trade it today, is because so that we will now be watch. So just mark this volatility 100 index. We're going to be watching it for the next 1 month, 2, 3 months, because this market, if you look at this each candle now, look at this candle that it take one day to form. If I count it, you imagine how many days it take for this market to rise. So let's even do a few counting. Let's count from here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38, 39, 40. So if you count before you realize that it must have taken like around 3 months for all this moving up and down to have happened. Around 3 months. So somebody could have bought this market like 3 months ago, and the person might be having like $4,000, $10,000, depending on how much you bought. at that time. So that is how you invest or you trade. So this kind of trade is called swing. It's called swing trade because you are keeping it for many days. Sometimes you just want to trade, like maybe you go to like 1 hour time frame, just want to take a trade within 6 hours, 7 hours, you come out and make your profit, So which is, we call it day trading, just trade within the day and you close and you make your profit. But it's always good to do your analysis using big time frame so that you don't fall into trap. When you already know that, okay, in the long run, where is the market direction? You now begin to trade in that direction only. You can be trading daily, but you know that, for example, now, when this market finally touch this place and it begin to sell, even though we might not trade for long days at a go, but anytime we want to trade this particular market, we know that we only be taking sell position. Because when we take sell position, okay, let me give you an example now. Look at all the candle here. Look at all the candle here. Look at the candle that broke this line down. You will see that the candle is very long. So if somebody traded one day and the only candle you get, for example, is this, or it's just this tiny one, or it's just this any of this tiny one, then you trade another day, you now get this candle, this red candle from here down. So you know that the profit you will make on this day will be bigger than the profit you make in any of these days, because these days you can see that the trade is very small, 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 small. So the target is that when you trade in the direction of the market, it will be giving you giant candle. So it means you make more money when you trade in the direction of the market. That's another secret about trading. When you trade in the direction of the market, it gives you giant candle. All right. So, for example, when the market is buying, look at this. Look at this green candle here. See, on that day, see the day the market went. Then it continued going. Then another candle here, another candle here, bulls. Then it came down again. Then it went up, bulls, 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 bulls. So now you trade in the direction of the trend. Look at it when it was going to start falling. See the red candle here, bulls. Then one came out. Then another one came out. See, bulls, bulls. So each of those candles that are looking big on each of those days, anybody that trade on those days will make more profit. Anybody who trade on those days will make more profit. So that is the whole idea. But when you trade against the trend, you can lose money. Then secondly, your results might not be massive. All right, so I'm going to stop here. If you have any question, you can send to me, then we can take it from there.